let's have a look at the third reason for money demand, okay, which then would then explain the negative relationship between interest rate and the demand for money. So the financial wealth of a household so this would be the portfolio of the financial wealth. So it can either be in terms of money or bonds, okay? And for this M can be further divided into two, M1 and M2, based on the reasons why household would like to hold money. So M1 would be the transaction and the precautionary demand for money. Okay, so this one, as we know, it has no relationship with interest rate. It has a positive relationship with income. So it doesn't really fit our purpose to explain the negative relationship between money demand and interest rates. This one, however, as we have discussed earlier, so there are some portions of money that which household would hold, okay, for speculative purposes, for speculative reason. So this one, so M2 and bonds, so these two would be a kind of like a substitute, a perfect substitute. So household, okay, will look at M2 and bonds as a perfect substitute. So they will either hold for speculative purpose. So speculative purpose, they will either hold everything in terms of money or in terms of bonds, okay? So it's either one of these two, okay? So we're going to look at the individual investor, okay? So an individual investor, for speculative reason, for the third reason, will either hold either money or bonds, okay? So remember, this is for speculative purpose. So, you know, what will then decide, you know, whether the individual investor should he hold bonds or money for speculative reason? So this one, it would depends on interest rate, okay? So Keynes, okay, argued that, okay, so firstly we need to know that there will be a normal interest rate, and which is Rn, and Rc is the critical interest rate. According to Keynes, each individual investor would have their own perception, you know, their own perception, their own calculation, like what should be the normal interest rate and what would be the kind of, so this one would be, you know, different, you know, each individual would have a different expectation, you know, different calculation according to themselves, you know, according to each individual investor, what is the normal level for interest rate. Okay, so try to pay attention to what I'm about to explain. So this will then, you know, really explain how an individual investor will then decide, okay, either to, you know, should he hold, you know, for speculative reasons, should he hold money or bonds, okay, M2 or B. Okay, so each individual will have their own expectation, their own perception on what is the normal interest rate. So then they will compare the normal interest rate with the prevailing market interest rate, okay, the prevailing interest rate in the market. Okay, so if they think, okay, so each individual will have a different level, so not everyone will basically have the same, you know, I might think that the normal interest rate will be 5%, a person A might say it's 6%, person B might say 7, you know, 8%. Everyone is free to have their own, because, you know, we use different method, different perception. So let's say, you know, whatever it is, we will then decide based on, you know, the prevailing interest rate market. We're going to compare these two things, the market interest rate R and the normal interest rate N. Okay, the normal interest rate is based on our understanding, based on our own calculation. So if we think that the current interest rate in the market is higher than the normal interest rate, so we would expect that the interest rate, the market interest rate, will then go down. So here, okay, if we think that the prevailing interest rate in the market is higher than the normal interest rate, so we expect that the interest rate will then go down because it's too high, okay? It's not supposed to be, it's too high, so we expect interest rate to go down. So as we know from our previous discussion, lower interest rate means, you know, there is a possibility for capital gain. Okay, for capital gain, in this case, we would like to hold bonds as much as we will. I mean, like, so there'll be zero demand for money. So for speculative reason, in that case, it would be better to hold bonds rather than money. If, however, you know, we think that the interest rate, the prevailing interest rate in the market is lower than the normal interest rate, so since the market interest rate, okay, is too low, so we expect that, you know, the market forces will then push it up. Okay, so we expect interest rate will then to go up, and now there is a possibility of capital loss. Okay, so whenever there is a possibility of capital loss, so now we have to do a simple cost and benefit analysis. We know that holding bonds will give us interest rate payment in return, so we will be willing to hold bonds as long as the capital loss is smaller than the gain that we receive from the interest rate payment. Okay, so this one will then boil down to the critical interest rate. The critical interest rate is where capital loss equals to the benefit that we would get from the payment from the interest rate. Okay, so basically we would get zero return. Okay, so capital loss, because between Rn and Rc, in this case we know that although we have capital loss, but the payment that we receive in return, okay, the interest rate, the return from interest rate is still higher than the capital loss. See, in that case we will still be willing to hold bonds. Okay, so unless the interest rate is too low, lower than the critical interest rate, so below this, so capital loss is much bigger, okay, than the interest rate return. So in that case, it's no longer profitable to hold bonds, so we would rather hold money. Okay, remember, this money we hold them for speculative reason. Okay, we might want to hold them just to wait for the right chance to buy bonds in the future. Okay, but since it is not profitable to buy bonds, so we liquidate them. We want to hold money. We just want to wait for the right chance to buy bonds back, okay, in the future. Okay, so this graph will then explain the investors, individual investors' decision, okay, on the speculative demand for money. Okay, so all these lines, so you can see that the function is discontinuous at RC. Okay, whenever the interest rate is above RC, the critical interest rate, that person would be would prefer to hold bonds. Okay, will hold bonds because above Rn you expect interest rate is too high, you expect interest rate to go down, so you expect capital gains, so you will be more profitable to hold bonds. Anything lower than Rn, the normal interest rate, you expect a capital loss, but the capital loss is still much smaller than the return in terms of interest, so you will still be willing to hold bonds. Okay, so no money being held for speculative reason, but any interest rate lower than the critical interest rate, now in this case it's no longer profitable to hold bonds. You would rather hold money, okay, for speculative reason, wait for the right chance to buy bonds then. So here we have two extremes. Okay, so we have a discontinuous function here. Okay, we have two extremes. So the individual investor will either hold everything in terms of bonds or everything in terms of money for speculative reason. Okay, so at this point the holding of bonds equals to WHI minus M1I, so zero money. And at this point the hold for bonds would be zero. Okay, so the person will hold for speculative reason, he will hold his financial assets in terms of money. Okay.